Types of investments explained. Imagine handing your hard-earned money to the universe and hoping it comes back with friends. That's basically investing, but not all investments behave the same way. Some grow steadily, others party hard and crash spectacularly. Here are the main types explained simply, with the good, the bad, and the occasional financial faceplant. Let's start. Stocks mean you own a tiny slice of a company. When the company does well, your slice gets more valuable, and you might get dividends. Basically, thank you payments for being an owner. Stocks can make you rich if you pick winners like early Amazon buyers, but they can also drop like a rock when things go wrong. Think of them as the roller coaster of the investing world, thrilling highs and stomach-dropping lows. Over the long run, they've returned around 7 to 10% per year after inflation. Bonds are essentially IOUs. You lend money to governments or companies, and they promise to pay you interest plus give your money back later. U.S. Treasury bonds are so safe, they're basically the financial equivalent of a warm blanket. Corporate bonds pay more interest, but come with the risk that the company might have a bad day and stiff you. Bonds won't make you rich overnight, but they're great for steady, predictable income. Perfect if you like sleep more than stress. Mutual funds take your money along with everyone else's and buy a big mix of stocks, bonds, or other assets. It's like hiring a professional shopper, so you don't have to pick every item yourself. Index mutual funds that just follow the whole market, like the S&P 500, are especially popular because they're cheap and tend to beat most people trying to pick individual winners. ETFs are like mutual funds' cooler, more flexible cousin. They trade on the stock exchange throughout the day and often have super low fees. You can buy an ETF for almost anything: tech giants, clean energy, or even companies that make money while you sleep. They make diversification ridiculously easy. Real estate means buying property you rent out or flipping for profit. Or you can keep it simpler with REITs, which are like stocks that own buildings, malls, or warehouses. Real estate can provide rental income plus value growth, and it often moves differently from stocks, giving your portfolio a nice safety net when the market gets grumpy. Commodities are physical stuff like gold, silver, oil, or crops. Gold is the classic, the world is ending investment. It tends to hold value when everything else is on fire. Commodities can protect against inflation, but they swing wildly and don't pay you interest or dividends while you wait. Cryptocurrency, led by Bitcoin and Ethereum, is the wild newcomer. It's digital money that lives on the internet and can moon or crash faster than you can say blockchain. Some people treat it like digital gold. Others see it as legalized gambling with extra steps. Smart investors usually keep it as a small, fun portion of their portfolio, not the whole retirement plan. Retirement accounts like 401ks and IRAs aren't investments themselves, but special wrappers that give you tax breaks. Put money in a traditional 401k and lower your taxes now. Use a Roth and pay taxes now for tax-free growth and withdrawals later. They let you invest in all the above options with government-approved perks. And lastly, diversification. Diversification across these types is the boring but powerful way most successful investors avoid huge losses while still growing their money over time. Start simple with broad index funds or ETFs. Learn as you go and adjust based on how much risk you can actually stomach when the market throws a tantrum. That's the main types of investments, broken down as simply as I could. Now I'm curious. What do you think? Was this explanation clear, or did I miss something important? Which type of investment are you most interested in right now? Or which one makes you the most nervous? Drop your thoughts in the comments below.